Hello children. Today we are going to discuss about a new chapter that is from company's account. Name of the chapter is Accounting for Share Capital. Children, we are familiar with the joint stock company, which we studied in our +1 business study class. To do the problems related to share capital, it is important to know clearly about this concept. So let us revise those concepts once again. Here is the meaning and definition of a company. So children, we have studied that company is an artificial person created by law, and its members, who are also known as shareholders, they take a share in this company. So the share capital of the company is divided into small units, which is known as shares. Let us see one of the definition of a company. A company is an artificial person created by law, having separate entity with a perpetual succession and a common seal. Now let us see the characteristics of a company. The first point is incorporation. Do you remember how does a company get incorporated? Yes, it is through the process of law. So a company is an artificial person established through the process of law. Then second point is separate legal entity. A company is an artificial person having a legal entity separate from its shareholders. So being it have a separate legal entity, it can own property, it can enter into contract, it can conduct the business, and it can sue or be sued for its debt and actions. The scope of the activities and the working of the company is regulated by the Memorandum of Association and Article of Association, as well as the provision of the Companies Act. The third point is perpetual existence. So the death and bankruptcy of the shareholders or the members of the company will not affect its working. The life of the company goes on until the life, as we know, the incorporation of the companies through law. So its winding up will also have the process will be through the process of law. So we can say that a company is having a perpetual cessation. Next point is limited liability. The liability of the members is limited to the value of shares subscribed by them. Then transferability of shares. The share of a company are freely transferable except for the private companies. Then management and ownership. So a company is not run by the members, all the members, but by the elected representative, which are known as directors. Then common seal. A company may or may not have a common seal. If there is a common seal, then that will be affixed in all the important documents of the company. So these are the 7 points of importance of characteristics of a company. Children, now let us know about the incorporation of a company. Incorporation means how a company get startup, how it can start its working. So there are 4 steps involved in the procedure for incorporating a company. They are promotion, then incorporation or registration of a company, capital subscription, and commencement of a business. So the first step is promotion. It is the first stage of the company's incorporation. A person or a group of persons agree to start the business in the form of a company. These persons are called promoters. So some group of people, they come together and they make a decision to form a company, and they are known as the promoters of the company. The second step in the process is the incorporation or registration of a company. So the company, to get incorporated, has to follow the procedure which is prescribed in the Companies Act 2013. The promoter, after getting the name of the proposed company approved from the registrar, he submits the Memorandum of Association, Article of Association, and concern of the first director to act as a director, and a declaration that the requirements of the Company Act have been complied with. So after doing these things, the registrar of the company will issue him the certificate of incorporation. So the company thereafter comes into existence. Now the next step is capital subscription and commencement of the business. So a company cannot commence its business or exercise borrowing powers unless a declaration is filed by a director with the registrar of the companies to the effect that every subscriber to the Memorandum of Association has paid the value of shares, if any, agreed to be taken by him. The second important thing is the company has filed with the registrar of the company a verification of its registered fees. When this two step is completed, then we can think about commencement of the business. That is, the business will actually start its working. What is the share capital of a company? Share capital means the amount that a company receives as a share capital from issue of shares. So when a share is issued, it can be both preference shares or equity shares. So when we issue the shares and we receive the amount, that part of capital is known as share capital. So what is a share? Share is a unit in which capital of the company is divided. Since or classes of shares, there are two classes of shares. They are preference shares and equity shares. As the name suggests, preference shares means they have certain preference over equity shares. What are the preference of preference shareholders? There are two preferences or privilege that preference shareholders have. The first privilege is, so here preference share is getting the dividend. What is dividend? Dividend is the profit amount that a company share with its shareholders. So dividend is the profit which a preference shareholder receive, and how they receive it? In a fixed amount or as per the calculated fixed rate. And the important thing is they get this amount of profit or dividend, what we call, before it is received to equity shareholders. That is the privilege given to the preference shareholders. The second right of preference shareholder is right to receive payment of capital on the winding off of the company before that of the equity shareholders. So capital in which the preference shareholder is also have contributed their money, they will get back that capital at the time of winding up of the company before it is paid to equity shareholders. So who will be number one to receive that before equity shareholders? It's preference shareholders. So these are the two rights which preference shareholders has. There are actually four broad classifications of preference shareholders. That is it with reference to dividend, reference to participation in surplus profit, reference to convertibility, and with reference to redemption. Let us discuss in detail. With reference to dividend, there are two types of preference shares, that is cumulative preference shares and non-cumulative preference shares. Cumulative preference shares means those shareholders which carry the right to receive the arrears of dividend before dividend is paid to the equity shareholders. Here arrear means in any of the year, if the company is unable to make the dividend to the shareholders, that is known as arrears. So the preference shareholders will get the accumulated arrear before it is paid to equity shareholders. So that is the first advantage. Then the next type of dividend is non-cumulative preference shares. Here the preference shareholder will not receive such benefit. Okay, so there are two classes of preference shareholders: cumulative preference shareholders and non-cumulative preference shares. So this come under the category with reference to dividend. Now with reference to participation in surplus, that is profit, they are again classified. Preference shareholders are again classified into two: participating preference shares and non-participating preference shares. Participating preference shares means what? The article of association of a company may provide that after dividend have been paid to the equity shareholders, holders of preference share will also have a right to participate in the remaining profit. Children, once the profit of the company have been calculated, they will distribute it to the preference shareholders first. Then they will give the with the prescribed ratio or prescribed percentage, they will distribute it among the shareholders according to the shares held by each of the shareholders, that is equity shareholders. If any amount is left, again after all the distribution, any more amount is left, that will be again distributed to the participating preference shareholders. Okay, so that is a right which preference shareholders that is a right which they receive. So preference share carrying this right are called participating preference shares. Non-participating means they will not get any dividend, that is remaining dividend after the equity shareholder have been paid dividend. After paying all the dividend to equity shareholders, if money is left, the non-participating preference shareholders, they will not get the money. Next category of preference shareholders are with reference to convertibility. There are two types of preference shares: convertible preference shares and non-convertible preference shares. Convertible means what? It will get converted into something else. So preference shareholders which carries a right to convert it into equity shareholders. So if preference shareholders, they no more want to be in the list of preference shareholders, they have the right to get converted into equity shareholders. And what do you mean by non-convertible preference shares? Non-convertible preference shares, they will not carry any right to get converted into equity shareholders. The only difference between equity and preference shareholders is they have some benefit, that is preference over the equity shareholders. Now with reference to redemption, what is the meaning of redemption? Redemption means the payment of the amount. Okay, so with reference to redemption also, we can classify preference shareholders as redeemable preference share and irredeemable preference shares. Redeemable preference shares are those preference shares which are redeemed by the company at the time specified. That means the capital amount of preference shareholders will be paid back to the preference shareholders at the time specified. That may be 20 years or more than that. So as per the decision between preference shareholders and the company, it depends. So as per the time specified, after that time, the preference shareholders will get back their money which they have invested in the business. So that process of giving back of the cash which is invested is known as redemption. So that is redeemable preference shares. So redeemable preference shares mean the company will make payment after this time specified. Now irredeemable preference shares means, so actually the meaning of irredeemable preference share is the preference shareholder will get the money only when the company will wound up. Okay, get back their capital amount only when the company will wound up. But as per the Companies Act 2013 does not permit issue of irredeemable preference shares. So Companies Act have cancelled such right to the preference shareholders. Now that was all about the preference shareholders. Now what is equity shareholders? Equity shareholders are those shares which are not preference shares. Stating differently, shares which do not enjoy preferable right of receiving dividend or repayment of capital are called equity shareholders. So equity shareholders, they will not get dividend at first. Who will get the dividend at first? It's preference shareholders. So they will not get the dividend at first. And the second thing is, they will not be given the capital amount also. Only at the time of wound, or when the company gets a wound, that is it shut down its working, at that time only the capital will be paid back to the equity shareholders. Children, you are familiar with the balance sheet of a company. You know that balance sheet is in this vertical form of balance sheet. We have as a Roman letter 1 equity and liability, and Roman letter 2 as assets. There is sub-classification in each of these items. The first item under equity and liability is the shareholders fund, and under shareholders fund we know it is the first item is share capital. Today we are going to discuss about this share capital and its various sub-classification. Here is the format of a balance sheet where we have disclosed share capital. So while drawing the extract of a balance sheet, you can see here equity and liability as the first heading. Then we have shareholders fund, and just below that you have to write share capital. Children, if there are more items in one particular head, that is in share capital, there is more than one sub-classification. So that we have to show as a separate note, that is known as note to accounts. So before that you have to mention here note number 1, that is your working note number 1. Then we have to write down notes to account as a separate box. So note to accounts. Then write down number 1. Number 1 means this number 1 is the working note number 1. And then write down share capital. Now you are going to sub-classify this share capital in the following way. Please listen to this very carefully. The first item under share capital is authorized capital. Under authorized capital, we know that there are two classes of shares, that is equity shares and preference shares. So you have to write equity shares, how many shares you are going to subscribe and what is the rate of one share. That also you will mention over here, and then multiplying the total number of shares with the unit value of the share, you will get the whole amount of the equity shares. So that we will discuss while doing the problems. So that the first category of share capital is the authorized capital. Then comes issued capital, And under issued capitals also, that two classes of equity shares and preference share have to be shown. Then we have subscribed capital. Under subscribed capital, there are two more types of capital, that is subscribed and fully paid up, and subscribed but not fully paid up. You can see here the terms like paid up, called up, that we will discuss in the coming slides. Okay, so these are the classification of share capital. You can see here calls in arrears which have been subtracted and forfeited shares which have been added. Children, these terms we will discuss in the coming chapters. Okay, when the chapter proceed, we will have more clarity with these terms. So for today, you just have to understand that in share capital, we have sub-classification of shares as authorized capital, issued capital, subscribed capital. Under subscribed, we have subscribed and fully paid up, and subscribed but not fully paid up. And you have to subtract calls in arrears and add forfeited shares. So this is the way you have to represent, and the total answer what you get after adding and subtracting the whole thing, that is the share capital amount, and the answer what you get here, that you have to show over in the balance sheet under share capital. Now let us discuss what are each of these terms and what does it means. First of all, authorized capital. It refers to that amount which is laid down in the clause of the memorandum of association of a company. In our previous class, we have discussed how the companies are incorporated, how it gets established. So they have to go for you have seen that promotion stage is there, incorporation stage is there. So incorporation stage, they have to present a memorandum of association to the registrar. At that time, in memorandum, there are some clauses in which the authorized capital of the company have to be mentioned. So whatever amount which you have written in the memorandum of association, that amount is referred as authorized capital. Okay, that is the maximum amount which a company is registered and authorized to raise from the public by issue of shares. By issuing the shares, the company can raise the money or capital. And that is authorized capital is the maximum amount. Beyond that, the company is not permitted to take or issue the shares or raise the money from the public. That is a maximum. Authorized capital is a maximum amount. Just remember it. Beyond that amount, the company is not allowed to take any single money. Not even 1 rupee should be collected. That is what is mentioned in memorandum as authorized capital. It is the maximum amount. This authorized capital is also known as registered, nominal or authorized capital. So these are the different names for this authorized capital. Next we have in that format issued capital. Children, issued capital means that part of the authorized capital. It is one part of authorized capital which is offered to the public for subscription. We are familiar with the word subscription. You have heard in YouTube and all that, subscribe our channel. You have subscribed your newspapers. So when you subscribe something, you will get the benefit of that in a coming years. So the public, when a share is offered to the public can subscribe it. Okay. So authorized capital, that part of authorized capital which is offered to the public so that they can subscribe it. It also includes the subscription with shares offered to the vendor for subscription other than cash is called the issued capital. So these things you will come to know when our chapter proceeds. So you just remember that authorized capital is issued capital is one part of authorized capital which we can offer to the public for subscription. Next, what is subscribed capital? It is the portion of the issued capital. So authorized capital is a part of issued capital is a part of authorized capital, and subscribed capital is a part of issued capital which has been subscribed by the public, which have been accepted by the public. The company have offered the share, and that part of the share which is the public is ready to subscribe, that subscribed part of share is known as subscribed capital. That is applied for and allotted by the company. Thus, face value of the allotted share is known as subscribed capital. Next is called up capital. The portion of subscribed capital which the shareholder are called upon to pay is termed as called up capital of the company. Children, the company have a choice. They can collect the money of capital from the shareholders as a lump sum. in one single installment itself, or they can in many installments they can purchase or they can collect the capital. So if they are collecting the capital in installment, that is more than one time period, it is to be remembered that whenever they call for that installment, it is called as called up capital. Okay, whenever they call for this installment, it is known as called up capital. So more than one time they can make the payment or capital money. Next is paid up capital. So the amount of called up capital which have been actually paid by the shareholders. When the company call for the capital and when the shareholders pay the money of the called up money, that time it is known as paid up capital. And the amount yet due, and if the shareholders is not paying that capital amount, at that time it become due, and what is at that time it is known as calls in arrears. Next is the reserve capital. Children, sometimes a company by means of special resolution decides that certain portion of their uncalled capital. Uncalled capital means that part of installment which is not yet called by the company. So that will be called at the time of liquidation. So such a part of uncalled capital is termed as reserve capital. Now we can see a difference between reserve capital and capital reserve. First thing, the meaning. It is that part of uncalled capital which cannot be called up except in the event of winding up. So by special resolution, the company decide that part of the installment which is not called by the company and will be called up only in the event of winding up of the company. That is known as reserve capital. And what is capital reserve? It is that part of the reserve which is not free for distribution as dividend. You know very well what is reserve. The some part of amount which is set aside for future use of the business. So capital reserve is such a reserve which is not free for distribution as dividend. This amount will not be taken to be distributed as dividend to the shareholders. That is the difference between reserve capital and capital reserve. This is one of the important question which is from this chapter's point of view. Creation. Then it is an uncalled capital. How this is formed reserve capital? It is an uncalled capital. And what is capital reserve? It is created out of the capital profit. That is when you sell a fixed asset and you got some profit, that is a capital profit. Then is it optional or compulsory? It is not compulsory to have a reserve capital, but it is compulsory, it is appropriate, we can say, to transfer capital profit to capital reserve. Then this resolution, only through special resolution we can go for a reserve capital. But for capital reserve, there is no special resolution required. Writing off of capital losses. It cannot be used to write off capital losses, but it can be used to write off our losses, or this money can be used to write off our losses. Disclosure. It is not disclosed or shown in the balance sheet, but it is disclosed, shown in the notes to account on shareholders fund under the head reserves and surplus. So under the head reserves and surplus, you can find capital reserve. Okay, so this is the difference between the reserve capital and capital reserve. Now